With us, Mr. Jaideep Nandi, the MD at Bajaj Consumer Care, joining us on the show. Mr. Nandi, hi, thank you so much for making time and speaking with us. I wanted to begin by discussing the margin performance itself because you managed to improve the margin by 80 basis points. What were the levers that aided the expansion and what's the outlook going forward for margins?
Yeah, I think what has happened is clearly for the last few quarters, our margins were under pressure because of our two key raw materials, LLP and RMO, which were really high. So last quarter, both LLP and RMO prices have softened. That has clearly aided the gross margins. Plus, our product profile has also started to slowly improve. We have been focusing on our premium portfolio, not only beyond ADH, also in some of the other personal care products. Very small still, but on that. So that have also started getting traction. So put together, both have started yielding results.
And going forward, is there more upside to the margins? It was what, 16.7% as the exit rate for FY24. What could be the overall number for the year?
So the quarter four EBITDA ended at 17.9% for our standalone sales. And we think that is where it will remain about range bound for the next year. Our marketing expense, we had elevated it last year to ensure that our new products are supported well. Plus, we had gone a little higher on our digital count while maintaining our conventional media. This thing. So marketing expense is something that we'll continue to remain invested in. So we expect that with LLP and RMO, both the key raw materials as well as our packing material remaining more or less range bound, we expect that EBITDA margin should follow mirror what we have been seeing in quarter four in the current and the near future.
Okay, so the margin expected to remain around the current level in the coming year as well. Wanted to get your take regarding the marketing spend that you just pointed out too. You had earlier indicated it will rise up to the level of 30%. What's the timeline for that and a color on how the international markets are doing?
Marketing expense, we had maintained that we'll keep it about 18 to 20%, and that has gone slightly down at about 17%, mainly because we have kept our overall spends of marketing about the same, about 42 crore rupees is what we are spending in marketing in ASP basically for the quarter. That is what has remained with the sales growth. Basically, the percentage has dropped a bit. So marketing spends will continue to remain at these levels. As I said, it will be split between what we spend on almond drops as well as the new portfolio. And it is also being split now with a higher contribution of the digital spends in media to support our new brands. So this is on one side. As far as the international business is concerned, that has been the focus for the company because that's where we have not been really present in the past. So this year we saw a 56% growth as far as the overall year is concerned. Quarter was even better, but these are obviously on low basis. And we have focused on key geographies. Middle East is one of the geographies we are focusing on. Bangladesh is a big market for us. And some of the rest of the world markets, so one or two markets for export, we feel we are zeroing in where we see that Indian diaspora, and especially the products that we have in our portfolio, have good traction. So we are focusing in few of these key markets, and we expect international to be a big growth driver for us in the next few years as
well. Jaideep, help us understand what really is the reality on ground when it comes to rural India, because clearly looking at Dabur's numbers, it seems like rural slowdown could be a reality. You perhaps would have a better handle on it.
So if you look at, that's absolutely correct. Rural, while there is a lot of news about rural markets improving, yes, they are recovering from no question. But given that where they had slumped, they have not yet recovered to the normal levels. Even if last quarter to look at, the rural markets were down. Even if you look at the overall hair oils numbers that Nielsen is reporting, the last quarter rural numbers were still negative, and negative by quite a bit. In fact, mid-single digit negative. It has improved from double-digit negative to mid-single-digit negative, but they are still negative. While hair oils have recovered and gone into just about positive territory, and urban has rebounded sharply and is now about mid-single-digit %. As far as we are concerned, we mirror similar results, except that our urban growth rates has been in high teens. So urban has been a big focus area for us. Retailing initiatives we have been taking all across. So urban has given us good growth in the general trade business as well as modern trade e-commerce. Both of them have performed well. So that has obviously aided our growth rates as well, because urban is doing well and our modern trade e-commerce as well as urban retail has done well. Rural, we have recovered, but given the pressures that we see in rural, we think that it will still take about a quarter or two to come back to its normalcy. But clear signs of recovery in rural.
Just before we let you go, you are expecting the double-digit growth to continue into FY24 as well, right? Will it largely be volume-led or price-led?
So price increases, in fact, while last year we have not been able to offset most of the raw material prices that had gone up, we have not been able to offset it by price increases because the demand situation has not yet improved. While now the demand situation is improving, we are seeing the raw material prices softening. So it may not warrant a price increase at this stage. So whatever growth rate you will see in realistic terms will be volume led. I mean, the value has to be driven by volume growth itself. Unless there is a structural change in the market, and if raw material prices were to go in some specific direction, south or north, then it will be a different thing. But at this stage, as it looks, volume will mirror more or less what value growth is.
Mr. Nandi, we let you go on that note. Thank you so much for joining us with